Good morning, everyone. Welcome and thank you for joining us today for the second of 3 webinars in the NAS Investment Solutions webinar series. Today's topic is the ABCs of DSTs. We know your time is very valuable, so the webinar will only last 30 minutes. There will be a presentation from industry expert, attorney and shareholder Joe McQuaid, and then an interactive discussion between Joe and Karen E. Kennedy, President and founder of NAS Investment Solutions and National Asset Services. If you have any questions for the panelists, please submit them by using the Q&A feature on Zoom. And without further ado, I will hand this over to Joe McQuaid.
Thanks, Roxanne. The principal reason that we care about DSTs is 1031. There's one of the best tax advantages available to us in the tax code is Section 1031. And the strategy for many people who don't need the benefit of their investment dollars is the so-called swap till you drop strategy, where one continues to effect 1031 exchanges of real estate they've held until they pass away, when their heirs receive a step up in basis, and any capital gains are never paid by the family. And so for a number of investors, achieving continued 1031 exchanges is an important strategy. The challenge is finding the right kind of property that's the right size, the right management structure, that's a fit for the exact size that a particular investor needs. And part of that challenge is that 1031 is not available for securities. So having an interest in an LLC or a limited partnership is not eligible for 1031 treatment. DSTs are special because, let's say a minute about DSTs. So a Delaware statutory trust is a bit of a misnomer. It's not a common law trust. We normally think of trust for purposes of estate planning that are sort of common law trusts. This is actually a creature of Delaware law, like a limited liability company or limited partnership. It has limited liability protection to its investors built in under Delaware law. It's an entity, a DST. In 2004, the IRS issued guidance that said that if a DST is properly structured, then someone who holds a beneficial interest in a DST will be treated as if they own the underlying real property for purposes of 1031. And they can exchange other real estate for a beneficial interest in a DST. And that is by contrast to other options. A REIT share or an LP or an LLC can't offer that 1031 treatment. Next slide. So some of the advantages of DSTs as compared to other 1031 options are that they offer enhanced potential for diversification, because an investor has the ability to acquire multiple properties, perhaps a smaller portion of multiple properties than they could if they had to deploy all of their 1031 proceeds in a single property if they were themselves. Unlike a single property or a tenant common situation, there's no risk of cash calls to the investor because the DST structure will not allow them. There's no risks from possible misbehavior of other investors. A common fractionalized 1031 interest is a tenant in common interest, where one owns a tenancy in common interest in a property alongside a number of other tenants in common. The problem is that the relevant tax guidance for tenants in common requires each of them to have a material say in certain major decisions. And along with that, there's the risk to any tenant in common that a different tenant in common could make an irrational decision and jeopardize their investment. So that risk is avoided with a DST. Also, with a DST, precisely because you don't have that major decision-making by the holders of the interest, you're able to have someone else take over the guarantee. A sponsor principal is typically signing non-recourse carve-out guarantees, and the investor is able to invest, have the benefit of debt financing, and not have to sign a guarantee at all. So that's a big advantage for a lot of folks. Next slide. You can go back. Yeah, there you go. Related to that, the kind of financing that's available in the marketplace for tenants in common is sparse and often not the most competitive terms. Particularly right now in the pandemic environment, finding debt is tricky, and where we're seeing debt issued on strong terms, it's where there's a proven sponsor, the lender's comfortable with the party that's going to be in control. And certainly there's bankruptcy protection elements inherent in the DST that make a lender more comfortable with that than they would be for a tenant in common transaction. In addition, there's the ability to aggregate with a DST that allows someone much better quality or certain nature of property that wouldn't be available potentially to someone if they were buying on their own. And also investors are entitled to receive their pro rata share of property income, unlike an LLC deal or an LP deal where there's typically a sponsor promote. The relevant tax guidance requires that everyone receive their pro rata share of proceeds, which is an advantage to an investor. Next slide. So what's the catch? What is the structural constraints of a DST? And there are a few. That 04 guidance from the IRS requires that control be vested in a signatory trustee, which is a sponsor affiliate. That is, the investors have to be passive investors. The debt has to remain constant. You can't have refinancing. You can't be changing the terms of the debt. The DST is not allowed to sign new leases during the 1031 hold period. There can be no capital calls, as I mentioned earlier. And each owner has to share profits in accordance with their share. And there can only be minor non-structural modifications to the property. So a lot of the structural requirements have given people pause, particularly when the DST structure was new, 15 years ago. But there have been strategies designed in the marketplace to deal with each of them in ways that have worked and allow most deals to be done. Go ahead, the next slide. So one of the challenges that people were concerned about was this prohibition on signing new leases. A lot of projects might, even a single tenant project might need a modification to the lease or signing a new lease if the tenant were to leave. The 04 guidance allows for a new lease in the event of a bankruptcy, but there's a lot of eventualities that don't involve bankruptcy that you'd want the flexibility to sign a lease. And certainly on a multi-family asset or a self-storage asset or something like that, you obviously are signing new leases all the time. So the structure that's been devised is that at the outset, a long-term bona fide master lease is signed that is baked into the structure, and that lease stays in place the whole time. And the master tenant, which is also in the control of the sponsor, has the ability to modify leases, assign new leases. And so that's the way we deal with the tax guidance, but deal with the practical realities of most real estate assets. Another challenge that people were concerned about was this inability to do stuff you needed to do. If you need to refinance or if you need to make major structural modifications, it needs to be, what happens then? And the answer is that there is a safety valve built into a DST where if you have to do it, the signatory trustee has the ability to automatically convert to an LLC and take care of what needs to be done. And I have seen some DSTs that had that happen. For example, they needed to refinance and then have converted back to a DST after that refinance took place. There's no guidance, there's no published tax guidance on whether that works, but the investor's position was, hey, we're going to continue to own it as real estate going forward. And so I think there's certainly some promise to the tax position that they were planning to take because they were going to then continue to hold it as real estate owners, that is, holders of DST interests going forward after that refinance. And then finally, inability to raise new capital. That is structured around by having ample reserves at the outset. And the one of the benefits to a DST structure is it can be seen as a benefit is this need to not refinance during the hold period. There is a finite date within which the sponsor intends to and has sort of a need to create a liquidity event for investors. There will be a refinance or a sale. It's expected a sale during that the tail end of the hold period, and that creates the ability to generate liquidity for investors, but also gives better planning opportunities in terms of having enough reserves for the projected hold period. There's a great level of certainty to an investor of knowing roughly when this is going to sell. So those are the ways that some of those DST challenges have been addressed, and as a result, people are able to use DSTs as a way to buy using 1031 money with fractionalized interest and achieve those benefits that we talked about earlier. That concludes my slide presentation. Let me turn the time to Karen for Q&A.
Thank you, Joe, and welcome everybody. You can see my grandchildren's art behind me. I usually have a virtual office going, but no such luck today. So enjoy the view. I wanted to take this time to offer to you some answers to some of the questions that were submitted either during the presentation or prior to. So I'll try and answer them, and Joe, if I miss something, I'll reach out to you. First one is there liquidity in a DST structure? As you mentioned in your presentation, there is a short-term and a long-term investment strategy that everybody has, taken on. The short-term is that there is no liquidity because you've invested your money in the real estate, and that's the intent during the hold period. And there's very little secondary market. Usually the best market would be to other investors in that deal who have been getting their checks on a regular basis. But they would expect, I've seen and would assume they would expect to receive a discount, not full face of what the value might otherwise be. Long term, there's a note that comes due and an action has to be taken. And it's at that point that the property then provides for a liquidity event. So that's, did I hit them all, Joe?
Yeah.
Okay. All right. Not bad for me. I'm not an attorney.
One for
okay. Save my parents that tuition fee. Okay. So second question. If I use a 1031 exchange to invest into a DST, then after I die and my children inherit the DST, what will their tax liability to the DST be? As Joe mentioned, there's a step up in basis. Every one of you who might be coming into a deal with proceeds in a 1031 exchange that you're deferring capital gains, you have your own basis in the property that you sold, the relinquished property or the down leg is commonly referred to. And that basis was carried forward from either prior deals, and you keep exchanging and you don't want to pay those capital gains taxes, understandably so. So when you die, then there's the only way to get out of paying taxes is to die. So if you die, when you die, then there's a step up in basis and your heirs inherit, and the value of the property at that moment in time is determined through any number of vehicles, most likely an appraisal or a broker's opinion of value. And then they pay their tax, their capital gains tax on the exit based on that number. But that's their obligation. Or it's yours, and then you have to, deal with it. Joe? Yeah?
That's right.
Okay. 2 for 2. Okay. I'm concerned about the loss of all control, even for major decisions in a DST. Should I be? Yes. You need to pick your investments very carefully because you're handing over the right to make all decisions to a person or a group. And those decisions should never be entered into lightly. You need to vet not just the property that you're considering investing that's going to be throwing off the cash and accumulating and accruing more, value as time goes on. That's the idea. You make your money when you buy. You know you made a good decision and you made a really solid investment when you sell. And then you see if the proof is in the pudding. However, if you've chosen a group, and I've seen plenty of them, as I know Joe has as well, that they don't care about what you've done. They don't care about how hard you work for your money. They just want their fees during the hold, and they make decisions that are not sound business decisions, either from a real estate perspective nor from a moral perspective, if I may be so bold. And so as a result, if you don't know who you're investing with, you should hit the door and do not look back. That's where mistakes are made, because at the end of the day, you're trusting somebody else with your hard-earned money.
One thing to add on that, Karen, there is, most investors don't have the infrastructure or the time to manage it themselves. So even if they're going to buy an asset on their own, they're usually going to involve a third-party property manager, and they're going to trust someone with the management of that asset anyway, probably in most cases. And I think the thing about whether they should be worried about a DST being passive, to your point, they should absolutely care who they're putting that trust in. But I think it's also important to realize you are at least putting your trust in a professional property property firm, a professional, and you don't have to put any trust in your co-investors who you know nothing about, who probably aren't trained, and maybe you like them, but if they pass away, their heirs could do something crazy and jeopardize your investment. And that's what you see in the TIC context.
Yes. The TICs, I used to say, and still do in many TICs, that it's like herding feral cats. It's not just herding cats, because everybody has their own objective. Everybody has their own thoughts as to how to do something. Everybody brings something different to the table. And based on that experience, whether it's in business or in life, they make their choices and they make their decisions. And many investment groups who do like what I do, they are not willing to listen to anyone else because they believe in their positions and their experience that they know best. And they should know more, but they should be willing to listen, because there's always something to be gained by listening if you listen carefully. That's my experience. So we try to listen. Sometimes it's not easy to get to the nuggets that are there, but everybody worked hard for their money. Everybody's money is valuable, and it's their investment, and it's for their families, and it should be listened to, because there's usually something worthwhile there that can be beneficial not only to the sponsor who is making the decisions as the trustee of the DST, but to all the other investors who have come in and are sitting and expecting their checks and expecting a great exit. Next question. What can I do to structure so I can have involvement? Find somebody who's willing to listen to you, who's holding your money, who's in charge of the DST, and willing to at least take your calls and listen. They don't have to act on what you're telling them, but find somebody who will listen with their ears open. That would be my advice. Next question. Next question. Is the acquisition of DSTs frozen now due to the current situation in the economy? No. The door is open again, and people are transacting. We're getting quotes on deals that we're looking at ourselves. We're much more careful as our lenders, as we all should be. We are very conservative in our underwriting. Lenders didn't used to be so conservative. They are now, because they've had to deal with the fallout from lack of choice and discernment at the time that they reviewed loan applications in the past. And so as a result, I think that's a positive thing. I don't see that as a negative thing. It holds everybody more accountable for what they see, and everybody is seeing different things, which goes back to what I was saying. As an investor, as a lender, they see other things because they're looking to protect their collateral, which is your investment. So it's good. Everybody should be working with the same goal in mind. Next question. Can a DST assist a member of an LLC who wants to do a 1031 exchange when the other members do not? Joe, I think you should take the first stab at that.
That's a question that's going to be fact specific and nuanced. Short answer is not immediately if you want to be safe. Taking a step back, if someone owns a membership interest in an LLC, they hold a security, and that is specifically excluded from 1031 under the tax code. Now, can a person receive a distribution in kind so that they receive real estate from the partnership? Yes, they can. They can receive a tenancy in common interest, or maybe better, and if you can do it, is an LLC can convert to being a Delaware statutory trust, a DST. If you do that right in the moment and then try and sell, it's likely that the IRS would argue that that was form over substance and that they might not respect that form. Whereas, given some time, you convert to a DST or distribute to tenancy in common interest, and then given some hold period, at least a year, maybe 2 years, where they're owning it in accordance with the established guidelines, then you could have the potential for investors to go their different ways and have one investor effect a 1031 exchange that's valid. So point is that's one to talk to an advisor on.
Okay. I think that says it all right there. Take, for instance, a DST that doesn't perform after the first 3 to 4 months, yikes, and continues progressively to underperform. Are there remedies to the DST shareholder? Number one, just like you always want to know, at least I do, I want to know who the bad doctors are almost more than I want to know who the good doctors are. I'd want to know who that sponsor is, that it couldn't even perform in the very first few months, absent a pandemic event and they bought a medical building or something. But other than that, that would be problematic. I guess you'd look at the offering memorandum or the PPM and all the disclosures, right, Joe? And see if something was missed. Yep. As to what was the cause, the root cause for what caused the asset to underperform so significantly. And there should have been reserves. There should have been, it was not properly underwritten, even in the face of something really horrific like the pandemic in a medical building. As a specific, we've been lucky. We have not had to add adjustments on any of the deals that we've sponsored because the tenants were so strong, which is great news. Rockwood. Okay. Did I hit them all, Joe? Is that right?
Yeah, you're great.
Okay. All right. How do C and S Corps operate using exchange funds for a DST? My thought is that they have to operate according to their operating agreements, take votes where needed, document their decisions within, by the officers responsible for doing so, and then they can exchange. They can come into deals as they deem appropriate and has passed muster within their own internal underwriting.
Yeah, that's right. And I think it may be helpful to think of an interest in a DST as buying real estate, because for federal tax purposes, that's what you're doing. So there's no reason that a C corporation can't buy a DST interest, or there's no reason an LLC couldn't buy a DST interest. They do with some frequency. I think most deals have some entities as participants in the DST because that entity wants 1031 treatment.
Right. Right. Is a DST loan recourse or non-recourse to the investor? If ever, this is my opinion, Joe, back me up here if I'm tell me if I'm wrong. If ever a DST, if you're told you have to sign its recourse and you have to sign guarantees, say no, lose their number, do not do business with them. That's not right.
Yeah, that's right. And one of the great benefits here is that, well structured, you don't have to sign a guarantee at all, and the sponsor kind of takes care of that for you.
Right.
And it's a non-recourse loan. It's just bad action carve-outs.
Right. It's bad boys, as they're commonly referred to. Right. When the asset is sold down the road, this is the last question. When the asset is sold down the road, can I exchange out and into another deal? And also, can my heirs, if that were to be the case, can they exchange out? Yes, that's one of the benefits of a DST. Like TICs in years gone by, you can exchange in, you can exchange out. Similarly in a DST. And if you pass during your hold period and your fractionalized interest is with one heir or several, they can likewise exchange out and do their thing as they deem fit, or they can pay taxes, whatever the choice is. It's up to them at that moment, right?
Agree.
Okay. Those were the questions that we took. So Roxanne, I hand it back to you. And thank you, Joe. And thank you all for attending. Much appreciated.
Thank you, Karen and Joe. Thank you to the viewers for submitting the questions. A recording of this webinar will be available on our website within about 24 hours at nasinvestmentsolutions.com. And you'll receive a brief survey via email after this webinar. We hope you take a minute to let us know your thoughts. And we hope to see you at our next webinar on July 14th. It is on self-direct and diversify IRA funds into real estate, discussing the ability to use IRA funds to invest in DST structured investments. So thank you, everyone. Have a great day.